Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving CVP analysis questions. Now let's get started. A company makes and sells product X and product Y. Twice as many units of product Y are made and sold as that of product X. Each unit of product X makes a contribution of $10 and each unit of product Y makes a contribution of $4. The fixed costs are also given to us over here as $90,000, and we are asked what is the total number of units which must be made and sold to make a profit of $45,000. So first of all, we see over here that we are selling twice as many units of product Y as that of product X. So basically we can say that we are selling 2Y and 1 X. So this is the combination that we are selling the product in. So basically what is the contribution that we are earning if we do so? Product Y makes a contribution of 4. So 4 twos are 8 plus X will give you a contribution of $10. That means you are getting a contribution, weighted average contribution of $18. So no, if you this is the total contribution, and if you weight that out, you have 18 divided by 3 because you are selling 3 units, 2 of Y and 1 of X. So the weighted average contribution that you get over here is 6. So now if you want to have this much of profit along with covering the fixed costs, so basically you have to cover 45k plus 90k, which are your fixed costs, and you divide that by your weighted average contribution, which we just found out to be 6. So this will give you your answer as 22,500. Moving on to the next one, Betis Limited is considering changing the way it is structured by asking its employee staff to become freelance. Employees are currently paid a fixed salary of $240,000 per annum, but would instead be paid $200 per working day. On a typical working day, the staff can produce 40 units. Other fixed costs are $400,000 per annum. So we have to find out what will be the effect of the change on the break-even point of the business and the level of operating risk. So first of all, we find out the current break-even point. So basically the contribution that I can see over here is SP is 60, material costs are 20. So I can say that my contribution is nothing but 60 minus 20, which gives me $40. So if I have to find out what my current break even is, so that will be how much we are how much is our fixed cost. So fixed cost is $400 plus $400,000 plus your employees, which are also getting a fixed salary of $240,000 per annum. So my fixed cost become $640,000, and then I divide that by the contribution, which is 60 minus 20, that gives me 40. So that means my current break even is at 16,000 units. Now if there is a change, so the new break even point will lead me to the fixed cost will now just be $400,000, and that will be divided by my contribution. Now my contribution will also change over here because the staff is again going to be a variable cost. So to find that out, I will have my new contribution as $60 minus $20 and minus again my how much is my staff making every day. So they will be paid 200 and they will be making 40 each day. So 200 divided by 40 will give you $5. So my new contribution comes out to be $35. So with this I will find out my new break even. Now my fixed costs have become 400,000. So 400,000 divided by my new contribution, which is 35, and now my new break even point comes out to be 11429. right? This is my new break even. Now in the question we have to solve how much the break even point reduces. So basically if you subtract 16,000 and 11429, you will have your answer as break even point will reduce by 4571. Now the next thing that we have to answer over here is what happens to the operating gearing. So whenever we consider operating gearing, it has concerns only with your fixed costs. So now if your fixed costs are decreasing, because we see earlier our fixed cost was 640, now it is 400, so our fixed costs have definitely gone down. So operating gearing also will reduce now that your fixed costs have reduced. So that is why operating gearing goes down is the correct answer, and that makes option B as the right one. Now if we move on to the next one, um, yes. So we have the next one with us. P company makes two products, P1 and P2. The budgeted sales for which are also given to us. We have the selling price, cost per unit, all right. If only product P1 were to be made, how many units to the nearest unit would need to be sold in order to achieve a profit of $60,000 per year? So now we see that we are going to be ceasing the production of P2 because we are only making P1 in this scenario. So now we have to find out the number of units. Number of units will be nothing but the fixed cost plus your target profit in your numerator, and we divide that by the contribution that we are earning with our product P1. Now let's find out how much the fixed costs are going to be. So for the fixed costs, I can say it will be, first of all, we have to consider this fixed overheads is 1.2 multiplied by how many units? 10,000. So first component of this is 1.2 multiplied by 10,000. Now the next thing that I have to consider over here is how much I was spending on per unit of P2. So this was $1 multiplied by 12,500 units. Now, another thing is that it is mentioned, however, P2 also, let's read the full sentence. Fixed overhead costs included in P1 relate to the general apportionment of overhead costs only. However, P2 also includes specific fixed overheads totaling to 2,500. So this means that this $1 that we are charging per unit of P2, this is also including 2,500, which is only specific to P2. Now that we are not going to be producing P2 anymore because only P1 is going to be made, that means my fixed cost is going to reduce by this amount because this was specific to P2. Now that P2 will not be produced, this 2,500 will also not be incurred. So with this, I find out my total fixed cost will come out to be $22,000. Now let's find out how much is the contribution. So contribution is nothing but your selling price minus all of your variable costs. So I can work backwards also. If I just subtract the fixed overheads from the profit, I will have my contribution. So this will be 3.2. Sorry, if I add both of these up, I will have my contribution. So 3.2 plus 1.2 will give me my contribution, and this will come out to be 4.4. Now I have my contribution also, and I have my fixed costs also. So now what do I have to do is, we want to achieve a profit of 60,000. So in my numerator I'm going to be taking my fixed cost plus the profit that I want to achieve, which is $60,000, and I will divide this with how much is my contribution, which is 4.4. Now I have my answer as 18,637. You will round this up to the nearest unit, right? This is the final answer. Moving on to the next question. Right. An organization manufactures and sells a single product, the G. It has produced the following budget. There's revenue, manufacturing, fixed variable, selling, fixed variable. Okay. If inventory levels are negligible, what is the break even point? So we have to work out the break even again over here. First of all, we have our, let's see how much our contribution is going to be. So we have our sales revenue, and if I subtract what is going to be my variable cost, which is 1400 and 400. So if I subtract both of these, so this will be 5000 minus 1400 minus 400. This will give you $3,200,000 as your contribution. Now, this is again for a total of 20,000 units. So, to find out per unit, I can just divide 3,200 with 3,200,000 with 20,000, and that will give me my per unit contribution as $160. Now, I have my per unit contribution. Now, let's have a look at the fixed costs. So, fixed costs are 1,600 plus $1,200,000. So basically, if I total both of these up, I will have $2,800,000 as the fixed costs. Now, to find out the break even, it is very simple. I will just take the fixed cost and divide that by the contribution per unit, which is $160, and with this I will have my answer as 17,500 units. Moving on to the next one, a company manufactures and sells a single product with a variable cost per unit of $36. It has a contribution to sales ratio of 25%. We have weekly fixed costs given to us as $18,000. So basically, what we can find out over here is we know the variable cost is given to us as $36, and we have the CS ratio as well. So CS ratio is basically nothing but what tells you how much is your contribution divided by your sales. So basically, if I want to find out my selling price will be nothing but if I just divide 36 by the CS 1 minus the CS ratio, which is 0.75, this will give me my selling price. So my selling price is nothing but $48. So with this we can also verify whether or not our answer is right. So if you take out 25% of 48, let me just do that on my calculator. 25% of 48 gives you 12, and if you do 48 minus 12, you have your answer as 36, which is your variable cost, hence it is verified. So this is your selling price, and if you subtract your contribution, which is 25%, which is 12, minus contribution will give you your variable cost, right? So this is what the variable costs are also given. This way your answer can also be verified that we are going in the right direction. Now we have to work out over here our break even point. For that we need our contribution. So contribution again we have worked out as $12. So this is our contribution. Now we have our fixed costs also given to us as $18,000. So basically the break even point can be determined by $18,000 divided by the contribution per unit, which is 12, and with this you will have your answer as 1500 units. Now moving on to the next one. A company makes a single product with the following data. We have okay, everything is given, budgeted output as well. In relation to the data, which of the following statements is correct? So let's go statement by statement. First of all, first statement says that the margin of safety is 40%. The next statement says the contribution to sales ratio is 24%. Volume of sales needed to make a profit of $270,000 is 45,000 units. And the last statement says if the budgeted sales increase to 40,000 units, the budgeted profit will also increase by $100,000. Now, let's consider this statement. So if your budgeted sales increase to $40,000, let's say as of now your budgeted profit is $30,000. So this means that 10,000 more units will be produced, and we will have a contribution of how much? If we just work out the contribution, 25 minus 5 minus 7 minus 3. So this will give you $10. So basically $10 is your contribution. so you will be earning this much per unit more. So basically the fixed cost will be the same. So that is why if you multiply $10, which is your contribution per unit, with the additional units, which is 10,000, so your profit will definitely be increasing by $100,000, which makes statement D as the correct answer. Moving on to the next one, the management accountant of Caroline PLC has calculated the firm's break even point from the following data. We have the SP, variable cost, fixed overheads. It is now estimated that the product's selling price and variable cost will increase by 8% and 5.2% respectively. Now, how much will the break even change with a result from this? So, as of now, we had a scenario of 20 and 8. Now, if we revise these figures, um, 20 will be multiplied by 1.08. So that gives you $21.6. This will be your revised selling price. And again, if you inflate your variable cost, which is 8 multiplied by 1.052, this will give you 8.416. So earlier your contribution was 20 minus 8, which used to be $12, and now your contribution will be 21.6 minus 8.416, and this gives you your contribution as 13.184. So earlier your break even was, this is your fixed overheads. So earlier your break even was 79104 divided by 12, and now your break even is going to be 79104 divided by 13.184. So if you solve this, you will have your answer as, let me change the color of my pen so that you understand this better. So this will give you 592. And if you go with this scenario, if you solve this, you will have your answer as 6,000. So basically we have to tell in terms of rise or fall in percentage. I can clearly see that there's a fall, so our answer is either going to be C or D. Now let's see how much is the fall. So how do we calculate the fall? Basically the difference is 6,592 minus 6,000. So this will give you a difference of 592 units divided by how much is your original figure. Original figure was 6592, and this will be multiplied by 100 to find out the percentage change, and this will give you your answer as 9%. So your break even point for the next year as a result of these changes will fall by 9%. Now, moving on to the next question. Edward sells two products with selling prices and contributions as follows. So, we have two products given to us over here. We have to tell the current break even. Okay. So, it is said that, okay, we have the selling price, we have the contribution, and we have the sales as well. So, basically, we will have to work out over here the weighted average contribution to sales ratio. So basically if I find out how much my revenue is going to be, so my revenue is going to be $40 multiplied by $150,000. So this will give me my revenue of 6 million, right? And similarly for product G, I will have it as 2 million. Now if I total all of these up, I will have my answer as $8 million, right? And then if I find out my contribution in the same way, it will be 1.5 million plus 0.4 million. So the total of the contribution will again give you 1,900,000. So this is going to be your contribution. Now if I find out my contribution to sales ratio, it will be nothing but 6 million divided by how much my contribution was for product F, and that was 1.5 million. So for product F, I can clearly see that my contribution to sales ratio is 0.25, And then for product G, it is again 2 million divided by 400,000, and that gives you $0.2. So this is my contribution. Now if I have to find out the weighted average, so this is going to be in how much proportion we are selling these products. So this will be nothing but if I just divide the totals, so 8 million divided by 19000000, so this will give you your weighted average CS ratio as 0.2375. Now with this you will find out your break even revenue. So break even revenue will be nothing but your fixed cost divided by your average ratio that we have just worked out. So fixed cost is 1.4 million. So if I just divide 1400000 by what I have worked out over here, 0.2375, this will give me my break even revenue, and this comes out to be uh, option D. So this is 5894737. Moving on to the next one, Edward sells two products with selling prices and contributions as follows. So again, I think this is a continuation. Yes, Edwards now anticipates that more customers will buy the cheaper product G, and that the budgeted sales will be 150,000 units for each product. So now we have to tell what would be the impact on the break even revenue if the sales volume of product G increases. Now we can see over here, this was for product F and this was for product G. We see that for product G, our CS ratio is lower. So that means that if this happens, if we are selling more of G, then this will reduce your average CS ratio, and as a result the break even will increase. That means you will have to sell more in order to have the same amount of revenue. So this will make the break even revenue increase by a different amount. So moving on to the next one. All right, this is a graph question. Right. So we have to tell over here that what does the shaded area on the break even chart above represent. So I can see over here that this starts right from zero. This line over here is nothing but our fixed cost. So and then over here we have our total costs and also our variable costs, right? So we have to tell over here that what is the shaded area over here that is representing. So in this area, until and unless the total revenue that we have, so the total revenue basically turns positive after we have covered all of our costs over here. So with this we will the shaded area basically represents nothing but the loss over here. So once you cross this line, once you go above this, you will have your profits. You have just break even over here at this point. So if I just remove this, the point over here, this is the break even point. At this point you have covered all of your costs, and then you will be entering into profits. Now, moving on to the next one, a company has produced the following PV chart for its sole product. So, it has only one product. Now, we have to tell over here that what is the fixed cost. So, fixed cost is basically nothing but where your, the line is cutting the vertical axis. So, basically, the vertical axis is this one, and 2000 is where it, meets the fixed cost line, basically is meeting this vertical axis over here. So I can say that 2000 is nothing but my fixed cost. Moving on to the next one. Right. So we have the break even chart given to us. We have level of activity, and we have to tell that which of the statements about the product is correct. So we see over here that the statement one says the product selling price is $10 per unit. Now, how do we find that out? Um, the line which is passing through the origin, see this one, this passes through the origin. So this indicates that your sales revenue what the sales revenue is at the various levels of activity. So at an activity of 10,000 units, basically the sales revenue is 100,000. See over here, this is 10,000 and this is again 100,000. So that means the selling price is definitely $10 per unit. Now let's have a look at the second statement. It says the variable cost is $8 per unit. Now this statement is not correct. Why? The sloping line which intersects the vertical axis at $30,000 shows your total cost at the various levels of activity, right? So the total cost at, if you see over here, this line over here represents your total cost. So this represents, at $10,000, it is somewhere around 80,000. So that means if you subtract your fixed costs, which is, I can see over here that the fixed costs over here are $30,000. So if you subtract 80,000 from 30,000, you have 50,000. So that means your variable cost per unit is $5 instead of $8. That is why this statement is wrong. Moving on to the third one, the product incurs fixed costs of $30,000 per unit. This is absolutely correct. It starts at $30,000. That means this is the fixed cost that we are incurring even if we are producing anything or not. The product earns a profit of $70,000 at an activity level of 10,000 units. So let's see, this statement is also incorrect. Why? We can see over here that the profit for 10,000 units is going to be nothing but the difference between your sales, which is 100,000, and your total cost, which is 80,000. So that means your profit is $20,000. That is why this statement is also incorrect. So you have your answer as 1 and 3 as the correct statements, which is option B. Moving on to the next one. Right. So each company manufactures and sells a single product. Okay. We have to tell which of the two statements are next to about the performance of H Limited next month are correct. So we see about the statements, all right. So first statement says 1921 units are required to break even next month. Second statement says 3152 units of sales are required to achieve a profit of this much. Monthly fixed costs amount to this much, and the margin of safety is this much. So we will see over here that which are the statements which are actually mentioned as correct. So first of all, let's find out how much is a break even point. So as of now, we know that the contribution is nothing but your sales price minus your variable cost. So the sales price that I have over here is 199, and my variable costs are 54, which is material, labor is 50, and then I have 20 also for my variable overhead. So basically, if I subtract all of these three figures from 199, I will have my contribution, and this contribution will come out to be $75. Another way to work this out in simplicity is if you take 53 and add 22 to this, you will arrive at the same answer, which will be $75. Now I have to find out my break even, my fixed costs. If I just find out how much that would be, so it is mentioned that the budgeted capacity is of 6200, and my fixed overhead per unit is 22. So if I just multiply 6200 with 22, I will find out how much is going to be my fixed overheads. So my fixed overheads are nothing but 136400. Now if I have to work out over here my break even, so I will just divide these fixed costs by the contribution that I just found out, which was 75. So that means my break even point as of now is 1819. So 1819, right? So this is why the first statement gets eliminated, because it says 1921. Moving on to the next one, we have to now find out how much is our profit going to be. So if we have to find out, we have, like, we want a profit of $100,000, right? And for that we will have to add this much of profit to the fixed cost and then divide by the contribution to find out how many units are required. So basically I will take this figure, which is 136400, plus how much is the profit that I want? I want $100,000 as my profit as well. And then I will divide this whole by 75. Now, if I solve this, I will have my answer as 3152. So that means 3152 units of sales are required. This means this statement is absolutely right. Moving on to the next one. Monthly fixed costs amount to 136400. This is exactly what we calculated. That means this statement is also correct. Now we have to work out the margin of safety to prove why the fourth statement is wrong. So margin of safety basically is nothing but your sales, budgeted sales minus how much you are required to break even, and you divide that by your budgeted sales. So basically over here, if I just erase some calculations to make space for my workings, right. So my margin of safety will be nothing but 6200 minus how many units was I needing to break even? 1819. So minus 1819, and divide this again by my budgeted sales, which is 6200. And if I just multiply that by 100, I will have it as a percentage, and this will give me my answer as 71%. So that is why fourth statement is also wrong, because this says 75%. So this is wrong, which leaves our answer as 2 and 3 as the correct answers. Moving on to the next one, we have a CVP chart given to us, right? Let's read what the question exactly says. Which two of the following statements about the company's about the above chart are correct? So point A is the break even point if the company's products are sold in the order of their CS ratio. Let's have a look what is point A. So point A basically the statement is correct. Why? Because point A basically represents your break even point if we are selling the product in the CS ratio. So now let's move on to the next one. Point B is the break even if the company's products are sold in the budgeted sales mix. So we see over here that point B represents exactly the point where the break even will be achieved if we are selling according to the sales mix, right? So because we have the options given to us over here, this is for product 1, this is for product 2, and this is for product 3. So this is again given in both of these scenarios. That means second statement is also right. Moving on to why 3 and 4 are not correct. 3 says changing the product mix in favor of product 3 will improve the overall CS ratio. Now why this statement is not correct is because, see, in the chart over here, if you change the product mix in the in the favor of product C, this basically product C has a negative contribution, and this will definitely reduce your total profit. So that is why this will negatively impact your overall CS ratio also. So that is why statement C is not correct. Moving on to statement 4. Statement 4 says if all the three products are produced, then the company can expect a sales revenue of $350,000. Now, if we go back to the graph up here, we see that if all three products are produced, then the company can expect a profit. We see that the profit over here is $350,000. We are somewhere over here in the middle. So that means the profit will be 350,000 and not the revenue. This statement says revenue, so that is why this is wrong. Both of these statements are incorrect. Moving on to question 97. This is the last question under this topic. The contribution to sales ratio for a business is 0.4, and we have the fixed cost also given to us. The budgeted revenue has been set at 6 times the amount of the fixed cost. We have to find out what is the margin of safety as a percentage of revenue over here. So basically, if I find out how much my break even revenue is going to be, so this is nothing but fixed cost divided by my contribution to sales ratio. So this is 1.6 million divided by 0.4, and this will give me my answer as 4 million. So 4 million is currently my break even revenue. Now my budgeted revenue is how much? 6 times of my fixed cost. So 6 multiplied by 1.6 again gives me $9.6 million. So this is my budgeted revenue and this is my break even revenue. Now, how did we find out the margin of safety? It is nothing but the difference between the budgeted and your break even revenue divided by your budgeted revenue. So this is 9.6 minus 4 divided by 9.6 multiplied by 100. And if you find out this, you will, again, please be very careful. You have to give your working to one decimal place. So you will have your answer over here as 58.3%. With this, we have finished this specific topic, CVP analysis. In the next video, we are going to be solving questions from limiting factors. Thank you so much for watching.